Okay, hello everyone and welcome to today's session on an introduction to fundamental analysis. So this session today will be run by me. I'm the president of the Investment Society, and also by Ryan here, who is our head of events. Just a disclaimer to start before we begin is that this is not financial advice. Anything we're saying in this session or in any others is not financial advice. We're not financial advisors and we don't claim to be. Therefore, any investments you make are off your own back and the price of your investment can go up and down at your own risk. We take no responsibility for this. Essentially, you can't sue us. So as an overview, on to the next. As an overview, we're going to start by putting fundamental analysis into the broader picture of investments. So what is an asset class? We'll be going into more details on what asset classes are in the next session. However, today you can see an asset class as a group of investments that have similar characteristics. So on the slides behind me, you can see in white the set of asset classes, and inside this you can see in blue the different asset classes and also in grey. So in blue you have commodities, FX, real estate and fixed income bonds, and in grey we have equities. Equities are in grey here because these are the ones we're going to be focusing on today. What is an equity? What is an equity? So an equity is the same as a stock or as a share. You might have heard either terminology used before, but they're all one and the same. An equity is part investment, part ownership of a company. So if you own a share, you own a small fraction of a percent of a company. Now we are going to zoom into equities further and look in particular at methods to forecast future stock prices. So again, saying that equities are the same as stocks. On this note, we have a question for you all. Next slide. Which of the following is not a method that people have used to forecast future stock prices? Number 1, measuring sunspots. Number 2, looking at phases of the moon. 3, measuring vibrations along the San Andreas Fault. 4, fundamental analysis, or 5, technical analysis. So if you just raise your hand with the number that you think relates to your answer. So there are a range of answers coming up here, mostly 1s, 2s, and 3s. But in fact, this was a trick question. So all of these have been used before to forecast future stock prices. There are so many different methods that people use to forecast future stock prices. However, there are 2 main ones, which are technical and fundamental analysis, which you will see in large in the next slide. So technical analysis is what Ethan was focusing on in his presentation last week, whereas fundamental analysis is what we are focusing on today. In order to put into context Fergus's presentation on passive investing, I will just say a few words on where this fits into the broader picture too. So passive and active are portfolio management strategies. So what you do is you have these methods to forecast future stock prices, namely fundamental and technical, and then the investment strategies of passive and active are used in conjunction with these. Before we begin on the differences between fundamental and technical analysis, it's good to note 2 theories of analysis. These 2 theories are called firm foundation and castle in the air. These are quite, these names are quite imaginative. You can think about what they really mean and it helps to remember helps to remember them. So firm foundation is the belief that each asset has an intrinsic value. This intrinsic value is based on present conditions and future projections of a company. And there is the belief that the market value will eventually revert back to this intrinsic value, which is because it is based on, this intrinsic value is based on firm foundations, hence the name, or on strong foundations of evidence. Castle in the air, on the other hand, is the belief that you can predict the future market prices by looking at what a crowd of investors is thinking. So during periods of optimism, investors create this idea of a castle in the air. This is a metaphor for something that is amazing, something they're considering to be a really worthwhile investment. However, during times of pessimism, this can crash to the ground because it is not built necessarily on a firm foundation like firm foundation is. So Castle in the Air is all about predicting these rises and falls by looking at the psychology of the other investors. I mentioned the intrinsic value of a company when I was talking about firm foundation. What is this intrinsic value? So the intrinsic value of a company is the hypothetical true value of a company. But it is important to note that the intrinsic value is very different when you're considering the intrinsic value of a company or when you're considering intrinsic value with regards to options pricings. So for option pricing, there is a specific formula which means that you get to the same answer each time. However, for predicting the value of a company, the intrinsic value of a company, analysts can get to a range of different answers because there is not one method of finding this out. Many investors can use the predictions of other analysts to work out what their own perspective is, and this is quite a good way of doing it, is looking at the average or just taking this into consideration when making your own decisions. So now that we have discussed that, it is good to go on to fundamental versus technical analysis. So as I was saying, fundamental is what we're focusing on today, whereas technical was what Ethan focused on in his presentation last week. Fundamental is based on firm foundation theory, which is what we were just discussing, whereas technical is based on the castle in the air theory. Fundamental follows the belief that the market is more logical than psychological. So in particular, it is the belief that the market is 90% logical and 10% psychological, whereas technical analysis is the opposite. So it's the belief that the market is 10% logical, 90% psychological. In respect to that, fundamental is all about the belief that eventually the market will return to its real worth. So when it strays away from this, eventually at some point in the future, it will return to its intrinsic value. Whereas for technical, there is the belief that the market moves towards what the crowd is thinking, what the crowd of investors is thinking for their perspectives. So now that we have done that, what is fundamental analysis? What does fundamental analysis entail? It is all about finding the intrinsic value of a stock or of a company, and then using this to determine whether to buy or sell or hold your position. Once you have found the intrinsic value of a company, if this intrinsic value is greater than the market value, then you would be inclined often to purchase the stock. In this respect, this is because the market, you believe, is undervaluing the company. So because with fundamental analysis, you're believing that at some point in the future, it will revert back to the intrinsic value, if the intrinsic value is greater than the market value, at some point in the future, theoretically, you will be making that profit. Whereas it's the opposite if the intrinsic value is less than the market value. How do you find this intrinsic value? So Ryan will be going into more detail on this, but the intrinsic value is the value based on companies' assets, the expected growth rate of earnings and dividends, interest rates, and risk. So these can fall into different categories, namely quantitative and qualitative methods, which Ryan will be discussing now.
Thank you, Amy. Hello? All right, let's go. Okay, so these are some of the famous fundamental analysis investors. Does anyone know their name? Maybe the first picture? Warren Buffett, yeah, that's it. Okay, and the next one is Peter Lynch, one of my favorite investors, and Michael Lee Chin. Now, I highly recommend going onto YouTube and looking at Warren Buffett and Peter Lynch's AGM talks in the 70s and the 90s. It's very informational for beginning investors, all right? Okay, now let's move on. Qualitative and quantitative fundamental analysis. What does these mean? Qualitative just means the intangible qualities that make up a company that we'll go into later. Quantitative means a quick look into the company's financial position across the board, how well they're profiting and so forth. Okay, qualitative fundamentals. So there's 4 key points: management competence, business models, competitive edge, and corporate governance. What do these mean? Management competence. So how good are execs in executing their plans? How well do they represent their shareholders? And how well do they communicate across the board between different nodes in the company, like with their board members or with different divisions in the company, right? Companies are huge with different teams. And then next we have business model. So business model is simple. How does the business plan to generate revenue? How do they plan to represent themselves internally? And competitive edge, also known as economic moat. How does the company plan to stay ahead of all their competitions, right? Think of Google. No one uses Bing or Yahoo nowadays. We're using Google because their code is better than the other software search engine providers, right? And then we have corporate governance, which is, it's been a lot of talks in the past 10 years about corporate governance, or known as ESG. How well does the company represent themselves in public, in the public image? How transparent are they? You don't want your execs to be committing frauds and stuff, right? That's no good. Doesn't make the company look good. You don't want to invest in a company whose suppliers dump their waste in the village next door. That's not how you're supposed to do business. That's wrong, right? We all know that. So for my qualitative example would be Disney. So anyone know why Disney shot up in prices during the pandemic? Yeah? Yeah, that's it. So on November 12th, Disney pulled a move. The execs told their investors that we're going to pull out our $3 billion annual dividend income for our investors. For some people, that's a big problem, right? Oh no, why are they cutting my income, right? So as a sign of good corporate governance, the execs listen to their big investors, right? And evidently, we can see, now I don't have a laser pointer, so I try to draw as best I can. If you can see right on top of that, can you guys tell which marker I'm talking, which candle I'm talking about? Right behind, Anyways, so this is what happened on November 12th when they told the news. And you can interpret it in a lot of ways. You can't really tell, there's no definitive answer. But I think there's a sell-off there because investors panic, right? Cutting their dividends without telling them what's going on. But in December 2nd, just 1 month after, the price, just before that jump, the last big jump, in between, the price gone up because the Disney execs hold an investor call and said, this is what we're going to do with Disney Plus now. Hundreds of lineups of shows. Have you guys seen Disney Plus shows? I've seen like Loki, Mandalorian, right? Everybody's seen them. And their estimate was 60 million to begin with, subscribers. Now, they completely blew up, right? Subscription boom. They were estimating 2024 is 90 million. We're already there. That's why we can see the prices in the end was almost $170. At this peak was $200 from the pandemic bottom, $80 when everything was closed. So what does this mean? This means there's value, right? Investors see value and the market corrects and follows and it shoots up in price in the end. So obviously for a lot of Disney investors, it paid off. Now, on to quantitative fundamentals. Before we go ahead, any questions? Okay. Quantitative fundamentals, what might that be? We're looking at financial statements. Three main ones, balance sheet, income statement, and cash flow statement. What is a balance sheet? Well, a balance sheet provides investors or potential investors with a company's financial position at any given point of time, indicating their assets, liabilities, and equities, right? So how do we find the total value of the company through the metrics they give us in there, right? It's just sheets of numbers. Well, we can find total asset value through using liabilities plus shareholder equities. What is asset? Asset means the entire value of the company. Could be the land Disney owns. I'm using Disney as an example. The land Disney owns, the Disney park, how much it's worth, the patents Disney have, and all that, right? And then we have liabilities. Liabilities could be long-term debt or short-term debt. But in this term, it's short-term debts. Plus shareholder equity. What is shareholder equity? Shareholder equity could be when the company liquidates tomorrow, how much money do the shareholder get back in return? So that's shareholder equity, the total value of the company. Then moving on, we have income statement. Now, income statement gives us a measure of the company's ability to generate revenue and performance of the company at the time it was released. The statement releases information like revenue, expenses, and net profit, also known as net income. It's interchangeable. Lastly, we have cash flow statements, right? So cash flow statement tells us the inflow and outflow of money in the company. So there's three main things when you look at cash flow statements. We have cash from investing, cash from financing, and cash from operation. What is cash from investing? So pretend you're an exec from Disney. You decide to open a new park in, say, Malaysia. You buy a plot of land that costs money, right? So you're investing it, and you're building a park that costs money. You're investing it. So there's inflow, right? Outflow of money from the company. Then hoping that you recoup the costs and make a return in the end. So that's cash from investing. That's what it tells you. Cash from financing would be the cash paid and received from issuing and borrowing money. And in the end, it's operating cash flow. Cash generated from day-to-day expenses from the operations of the company. So you might ask, okay, give me the rundown. Which one should I be looking at, right? There's so many pages of this in the end. There's so many numbers. Well, I can't answer that because they're all interchangeable and you can put them together and they'll tell you different results, okay? Not any one of those statements can give you an all-rounded view on the company performance, but general consensus is we look at income statement because it tells us the company's ability to generate revenue, right? And you can compare that to older data see if the company is improving or expanding. But there's another thought, that is that we look at cash flow statement, because some companies are able to use accounting magic, I would say, to make their company look more profitable in the short term. An example would be Enron. If you guys know Enron, it's an early 2000 company, turns out to be a fraud because they've been cooking the books. Next, we'll look at ratios from the statements and all the numbers inside all those three statements, right? We have net profit margin. What is net profit margin? It measures how well the company brings in a profit when considering their cost as well. This is the profit margin equation, yeah? But net profit margin is slightly different. It's because there's three different types of profit margin calculation. Net profit margin would be the one we usually look at, since it includes the liabilities of a company. Most other ones don't tell you that. And it's important to know how much debt your company is carrying when you invest into them. Afterwards, we have price earning ratio, PE ratio, known as, it's very easy to find. If you have a phone, you go on your stock app, scroll down, it will tell you PE ratios of all the companies. Why we use PE ratios is because we can use it to compare companies in the same industry with the same similar earnings, right? Basically, we're looking at how much the company is profiting and how much is the stock worth, respectively, and comparing it like together. To find the earnings, it's very simple. We simply find the net profit of the entire company and then divide it by the amount of shares outstanding of the company. Then we plug that number in below the daily stock price, and that's how you find PE ratio. Then we have current ratio. Now, current ratio is back again to debt. We use this method to see how well the company cover their short-term liabilities. Is the company enough to stay afloat when they have a large holding of debt during when the company is in heavy water during financial crisis? Will they have enough money to come up with to cover their debts? If not, then they will have to liquidate, and it's game over for the company. And at the very end, we have dividend yield. So a big investor who likes dividend yield would be Warren Buffett and Charlie Munger in the Berkshire Hathaway company. What does it tell us? It tells us if, for example, if I put X amount of money of cash into the company, how much are they paying me back annually or quarterly? So for example, say Disney gives you 3% dividend income. I put $100, $3 every year. So this is my quantitative example. We have Coca-Cola. And remember I said we can use these data to compare with their competitors in the industry. So PEP means PepsiCo, all right? We look at current ratio, so how much assets they have compared to debt. Coca-Cola seems to be doing better, right? They are able to have, they have 1.47 more times of liquidity and assets compared to their debt, whereas Pepsi is slightly lower. Net profit margin, double of Pepsi's, right? Speaks for itself. They're able to generate more revenue. And then we have annual dividend yield. It's slightly different, but makes a big difference when you put a lot of money into the companies. I'm not telling you invest into Coca-Cola because Pepsi's bad. Don't do that. This is just up to you to interpret these data. Next, we have the more in-depth models on how to value a company. WACC, known as weighted average cost of capital. What does it do? It allows us to better understanding how the firm uses debt and equity to grow and affect the firm's cost of capital and corporate valuation. So what does this mean? So a company might borrow a lot of money, debt, to grow exponentially, right? Only if they have enough assets to cover when they need it. So for example, there's an equilibrium actually, the equilibrium of WACC. Once a company crosses that, they have more debt than assets they actually have. If they're in financial trouble, then they have to liquidate because they owe too much money, right? So the general rule of this calculation model is the greater the company debt, the lower the WACC number would be. Then it reflects into a higher stock price, only when they are able to utilize it to its full potential by not crossing the equilibrium. So again, we can see this is exact decision. This is a qualitative fundamental analysis, how well the execs perform in their roles, right? Next, we have Gordon growth model. It functions as a fundamental framework on determining the dividend discount and intrinsic value of the stock price based on future series of dividend that grows in a constant rate. Note, constant rate. It's widely applicable for companies that are relatively mature and stable. So again, Coca-Cola, Pepsi, McDonald's, been here for decades, right? Relatively mature, not really looking to grow exponentially, just steady pacing themselves. So the caveat of GGM is it assumes company dividend will grow at a constant rate in perpetuity, forever, infinite. That's not possible, right? Your company cannot just keep growing to infinity. So that's the problem. This calculation doesn't account for time frame. It's to infinity. And it also doesn't account for market volatility, right? If there's a financial crash, nobody can tell. That's unaccounted risk. It also doesn't account for corporate life cycles, if any one of you know what that is. So when a company begins, they can grow exponentially very fast. But as it matures, we tend to level off or even drop a little bit because it's harder to maintain that much money, right? And investment. And last, we have capital asset pricing model, CAPM. So what does it do? It establishes a relationship between our investment and risk. Risk is a big part of the finance community, trying to figure out the risk of your portfolio, the risk of investments, right? So the asset's expected return measures the asset's risk, which is, if you look on your stock apps, would call beta. Beta equals risk. And assessing the performance of financial portfolios and their assets, respectively, we can estimate the firm's cost of capital and equity. Now, again, there's a caveat to this equation and this model, and it's that it's based on past performance of the company. And we all know that past performance is not relative to future returns, right? It doesn't tell us the whole picture. It's a good estimate, though, on expected future returns, but it only works as an estimate because this method does not account for unexpected risk. Your beta value does not account for an earthquake or a tsunami that wipes out a Coca-Cola plant and they're not able to bottle their drinks, right? Does not account for that. And a lot of scholars would say it poorly reflects on the real world and the market condition because the market always evolves. And therefore, it affects the values and changes the beta. So this is the end of fundamental analysis. And I hope you understand a little bit more about these financial models and what these ratios do and able to use that at full potential for your future investments. Thank you.
So in terms of some future reading or any further reading that you might want to look at. So there's a book called A Random Walk Down Wall Street, which is a good read, and also our blog, The Student Investor. There is also one of our partners with the society is called Intuition Now, and they run a financial statement analysis course, which is really useful and will help a lot with this. They offer a free banking and finance course for all members of the society and a 40% discount on all other courses, including the one that I mentioned. There's also a link here for one of the information slides about Disney, and you can also subscribe to the Financial Times for free using your university email. This is